Is there a genuine risk of a major real estate correction? Do you think there is genuine risk opportunity in real estate value falling? I wonder if there might be a low ebb in the market coming that should be an opportunity. And is there a risk that the government may step in to regulate rents? I think there's two questions there. Let's address the first one. Is there a genuine risk of a major real estate correction? And is this general ebb and flow of the market an opportunity for us to enter into? So let's go back, because we've already had almost a 10% correction in Sydney, over 5% correction in Melbourne. That's a pretty substantial correction in any asset class. That a 10% pullback is considered, as mentioned, an entry point by many sophisticated investors. Will it continue to push and to correct further than 10% in Sydney and Melbourne? Maybe, maybe not. It might in other states as well, but remember, each city, each region, so not just Brisbane, but also then southeast Queensland and then coastal Queensland and then rural Queensland, 4 individual push and pull markets within Queensland alone, and then individual cities within those precincts. Remember, they are all pushing and pulling in different directions. So broadly, anything more than a 10% correction is a major correction when you consider Sydney and Melbourne might go backwards 10%, while at the same time Perth might have gone ahead 5%. So for an overall market to pull back more than 10% is a major correction. Is it likely to occur? For me, it's very unlikely because, and I've mentioned it before, the major driver of investability or investors entering into a market is their rental return or income associated with that broader investment. Dividends, or property. Obviously, we have rents associated with that property investment. They would need to collapse to stop people entering into that market. And the second part to your question there is around, would the government step in and regulate rents? Well, I'd have to regulate it for rents to go backwards to create that negative price pressure. Because at the moment, investors have got money in their pockets, are deciding, do I put this money into the share market? Do I put it into, managed funds, or do I put it into term deposits, or do I go and buy a new car, or do I invest it in renovating the house, or do I invest in investment property? They are weighing up their investment options every single minute of every single day. And they are just moving their money into what generates the highest return. And a large component of return is obviously always income. So for me, property prices to collapse or to have a catastrophe in the marketplace, you would have to see a collapse in the rental income associated with those investments. And it's not likely to decrease. Even if the government came in and legislated against rental increases, they're not going to force people to now start accepting less for rent for those properties. So you wouldn't expect rents to decrease and then therefore property values to decrease past that rental yield. So if an investor's looking at that with a 5% rental yield and they're looking at dividends coming out of the stock market at 3 or 4%, they'll still move their money over into property at a really high level, at a theoretical level. You've then got inflation. And this is maybe the large concept that, the elephant in the room. The rental income might not devalue. Or change. But the actual value of that rent in real spending power is decreasing. So when you have that decrease, we've got negative real interest rates still today. Theoretically, the RBA is playing catch up always, so we might not have negative real interest rates right now. But, generally we're in a negative real interest rate environment at the moment. So our debt is devaluing faster than the interest we're paying back to the banks. So it's a profit-making exercise actually having our money borrowing money into property. So whilst that's occurring, it's also occurring to the income side of the equation as well. If we are charging $500 a week in rent today, and at the end of a 12-month lease, it's still $500, obviously, well, it's less spending power for that $500. So it's very unlikely that the government would legislate to have rents decrease, even though they're the same. Our real spending power is decreasing, and we have upwards pressure on rent just because of inflation. So I don't see the backbone of the market falling out. And probably the final part of that question there, Christine, is around, does these pullbacks in the market create opportunity? For me, I don't look at pullbacks to enter into a market. I look at very particular circumstances as an entry point. Let's look at the positive and not the negative. When we can find these unique sets of circumstances, our buying rules, when we see an opportunity fall in between our goalposts, then you're training yourself, you're learning and building that confidence to be able to execute then. And for me, those opportunities always exist. When you know how to go out and find them, there's sometimes more of those opportunities and sometimes less, but I really don't look at these macro push and pulls, because I know that really when you come into it at a city level or a local government area level, these are running their own race. You know, if you've got an area that's got new projects, you know, wonderful, diverse new employment and new projects going on, you've got lots of population moving towards there, you've got housing shortages, rental yields are through the roof, well, that's running its own race, irrespective of what else is going on the macro environment. So for me, it doesn't really create an opportunity, because if you are, educated and empowered, you're creating your own opportunities in every market. For me, it was the majority of my investments purchased through the GFC and a couple of years after that, when everyone was, doom and gloom.